You know, that idea right there is the key to everything we're about to cover. The moment you stop thinking like you're just playing a game and start thinking like you're an actual business owner, the questions you ask, well, they change completely. And so do the answers you find. So today, that's exactly what we're going to do. We're giving you the tools to think like an owner. Welcome to our guide for decoding those tricky financial metrics. Look, if you've ever glanced at a company's financials and felt like you needed an MBA just to get what's going on, trust me, you are not alone. A lot of that complexity, it can almost feel intentional, right? But today, we are cutting right through all that noise with a really simple but powerful framework. Our mission today is pretty straightforward. We're going to tackle the 4 fundamental questions that you absolutely have to answer before you even think about investing a single dollar. Think of this as your new pre-flight checklist for any investment you're considering.
All right, first up, the most basic question of all, right? Does this business actually make any money? To figure that out, we have to look at the bottom line.
Okay, so our first tool for this is something called net margin. This thing cuts through all the confusing accounting jargon and just asks one simple question. For every single dollar a company brings in from sales, how many cents are left over as pure profit after all the bills are paid? It really is the ultimate bottom line. And the best way to think about this is with a classic lemonade stand, right? So you sell your lemonade, you pay for the lemons and the sugar, you pay your helper, you even pay back that small loan you got from your parents. That little bit of cash you can finally actually put in your pocket, that is your net margin. It's really as simple as that. You see, net margin tells a story. I mean, just look at the difference here. Apple, with its premium brand, gets to keep almost 24 cents of every single dollar as pure profit. Walmart, on the other hand, less than 3 cents. So for Walmart to win, they have to rely on just massive sales volume. Now, neither of these is right or wrong. They're just 2 completely different strategies to win in their markets. Okay, let's grab our next tool and see how this all starts to build a bigger picture. It's called return on equity, or ROE for short. Now, this metric asks a slightly different question. It's all about how good is the company at turning the money that we, the shareholders, gave them into even more profit. It's really a measure of how skilled the management team is.
And, sometimes a number just completely stops you in your tracks. For Apple, in 2024, for every single dollar that shareholders had invested in the business, they generated over $1.57 in profit. Just let that sink in for a second.
So, how is that even possible? It sounds like magic, but it's not. It's finance. See, Apple has spent years and years buying back its own stock. When they do that, it shrinks the equity part of the equation, which then inflates the ROE ratio. It's a really powerful reminder that you can't just look at a number. You always have to ask why it looks the way it does.
Okay, so we figured out a company's profitable. Awesome. But that's really only half the battle, isn't it? This brings us to our second crucial question. Are we getting a good deal? Because let's be honest, even the world's greatest business can be a terrible investment if you overpay for it.
The classic tool for this is the price-to-earnings ratio, or just PE, and it asks a really simple but powerful question. Basically, for every $1 this company makes in profit in a year, how many dollars do I have to pay to own a piece of it? You can really think of it as the price tag on a company's profits. Now here's a super important point. A low PE doesn't automatically mean buy it. Just take a look at this comparison. You would pay way more for $1 of Apple's profit than you would for $1 of Ford's. So why? What's the deal? It all boils down to one simple word: growth. The market is basically betting that Apple's profits are going to grow much faster in the future.
So, how do we actually account for that growth? Well, that's where the PEG ratio comes in. I like to think of it as the PE ratio's smarter cousin. It takes that PE number and divides it by the company's expected profit growth rate. The legendary investor Peter Lynch made this famous, and he basically said that a PEG ratio right around 1.0 is a good sign that a stock is fairly priced.
And this is where the PE ratio really shows its power. If you just look at the PE, Amazon looks way more expensive than Walmart. But the moment you factor in their expected growth, the whole story just flips on its head. Walmart's P ratio is actually higher, which suggests that when you buy its stock, you're getting less growth for every dollar you invest. It just goes to show you context is absolutely everything.
Okay, we're making progress. The business is profitable. The price seems fair. We're almost there. But now we have to ask a really tough question, the survival question. What happens when things get bad? In a tough economy or some kind of crisis, will this company actually make it? It's time to check its financial safety net. And the tool for this job is the debt-to-equity ratio. It tells us a lot about how a company is paying its bills. Is it using money from its owners, that's the equity, or is it being fueled by borrowed money, which is debt?
A really good way to get your head around this is to think about buying a house. Your down payment, that's your equity. The mortgage you take out, that's the debt. The more you borrow, the more leverage you have. And here's the thing, if the house price goes up, your gains are magnified. But if the price goes down, your losses are magnified too. It works the exact same way for a company. Debt can be an incredibly powerful tool, but man, it is a double-edged sword. And as you can see, what's considered normal here can be totally different depending on the industry. I mean, Netflix took on a bunch of debt on purpose, strategically, to build its huge content library. Walmart's debt is higher, but it's backed up by super stable, predictable sales. So there's no single magic number. The real question you have to ask is this debt being used to actually grow the business? And can the company comfortably afford to make its payments?
Phew! We've covered a lot of ground here. We've looked at whether a business is profitable, if the price is fair, and if it can survive a downturn. So now, let's bring it all home and see how we turn these numbers into a single, coherent story.
So this is it. This is your new toolkit. You don't need a fancy finance degree. With just these core ideas, you can get a surprisingly clear picture of almost any business. You've got net margin to check for profit, the PEG ratio to see if the price is fair, and the debt-to-equity ratio to understand the risk. It's a simple framework, but it's all about asking the right questions.
Because at the end of the day, this isn't about memorizing a bunch of formulas. It's about learning to ask the right questions. You now have the tools you need to look right past that flashy ticker symbol and see the real business hiding underneath. You've got the framework to start thinking like an owner. So the only question left is, what business are you going to analyze first?